This is lesson 3, step 3, paying off debt, all a part of my winning with money course, winning with money process. And lesson 3 today, we're talking about the basics of understanding credit scores. So the biggest thing to understand credit scores is first that we need to understand credit reports. We can't have a credit score unless we have a credit report. And in our credit report, there are 3 big things we need to understand. The first thing is the credit reports show our credit history. So that means all types of loans that we've taken out, bills that we've paid or have not paid, credit balances, our income level, all that is thrown into our credit history. And this credit history is collected, all this information is collected by the 3 credit agencies. That's Equifax, Experian, and TransUnion. And together, you can order your credit report individually from all 3 of those companies, or you can, by federal law, you can order a free credit report from annualcreditreport.com. You can just look that up and it'll be the first thing that pops up. You do get a free credit report, and this will help you determine, what you can do to fix your credit or help your credit out. And then the credit report also all the items will calculate to help determine your credit score. So what is on our credit score? The first thing, I broke these down in chronological order from the greatest weighted amount that determines your credit score to the least amount. So 35% of our credit score is weighted on our payment history. So this is how much we have paid and for how long we have paid. So they want to see credit reports, credit score. They want to see your consistency. The next one, total debt balance. 30% of that total debt balance. This is showing how much we owe or have owed on past balances. And this is also important because we don't want to max out our loans. So say I have a $1,000 credit limit on a couple of different personal loans or credit cards, and I max them out each month. That might affect my total debt balance. On the flip side of that, I also want to make sure that I'm at least using more than 10% of it. Some people say you want to use, this is called utilization rate, by the way. Some people argue that you may want to use like 40 to 60% each month when you're using your credit accounts or your credit limits, whatever that might be, because you do want to show that you're using some. So total debt balance, biggest thing is you don't want to max them out every time. 15% is how long we've been using credit. So how long we've been using credit, and also making sure we're not opening a bunch of new credit. 10%, the different types of credit. So not just having one credit card, but showing that we can pay off multiple credit accounts. This is why it's wise to open maybe a credit card when you're really young under your parents' name. That way you can, with a very low limit, you're paying for basic things. You can start building up some credit history. Business loans, they want to see that. Car loans, personal loans, mortgages, all that is important to build up a little diversity in our credit portfolio. And also kind of ties in with this third one here with the 15%er. 10% new loans or new credit accounts. If you just started taking out loans all of a sudden, that might take your credit score might take a hit because you're opening up all these new loan accounts or new credit accounts. So make sure when you're opening up accounts, you might open up a credit card this month, and then maybe next year you might need a personal loan, and maybe 2 years after that you take a mortgage out. That way you're not opening up a credit card, getting an auto loan, getting a personal loan, opening a mortgage account all in the same year, because that could affect your credit score. So what is a good credit score? This all depends on the lender, or it depends on the person you're loaning the money from or you're building credit on. So like if you go to a car dealership and you're getting a new car, this can affect what they think might be a credit score. This can change from state to state. What I've put down on my slide here are generally suggested great, good, fair, poor credit scores. So usually 750 plus, you have a long history of credit use, consistent history of paying off credit, used multiple credit accounts, never had an unreasonable high credit balance. Usually you can get favorable terms there, but just remember that different lenders, different states, they might have different determinations on what's considered good or bad credit score. The next level, we have good credit score. So we have a strong credit history, might have missed a few things though. The one below that, fair, we're behind on several payments, might have a large debt balance that's going to take several months to pay off. And then you have poor credit score. Very little to no credit history. Maybe they opened up, maybe we've opened up several different credit balance accounts. Maybe we've missed several payments consecutively back to back to back. All this can affect our poor balance here. Doesn't mean if you're at this level, though, you can always get higher. You can always go up and increase your credit score. Again, these are just, I just want to make sure that everybody understands this is just suggested, though. So it really depends on the lender, depends on the business that you are taking credit out of. So the worst things for your credit score can vary. The top worst things you can do for your credit score all changes depending on the state, depending on your lender, depending on the business that you are taking credit out on. Credit account can be closed because of the overcharged line of credit. So if you've overcharged several times and you've extended that line of credit, then your credit account can be closed. This will greatly impact your credit score because they will report this to the debt collection agency. There's tons of debt collection agencies out there. The credit company or the lender that you are taking money out on, they may send that, they'll close your account first. They'll still demand you repay. This usually is somewhere between like 3 or 6 months of missed payments. And then they'll write that off, which is kind of funny. They'll write that off as a loss, as uncollectible debt. And then they'll report the rest of that remaining balance, that 3 to 6 month missing payment, to a debt collection reporting. And then the debt collection agency, they'll report that, and boom, your credit score has taken multiple hits in that time. Foreclosures, obviously that was the huge, because you've missed, not only have you missed multiple payments, but you failed to provide document as to why, or you've lost a huge asset too. You've lost your house, you lost your property. So large balances will be reported to debt collection agencies. Bankruptcy, probably the worst thing because it just wipes your credit score. We're going to talk about this more in the next couple of lessons. Bankruptcy will wipe your credit score, not clean, but it'll wipe it out entirely to the lowest level, and then you have to rebuild. And most likely, you really can't recover much from bankruptcy. And then we'll talk about repossessions. Once you get to a certain point, you missed kind of like foreclosure, your cars, your personal belongings, whatever it is you owe on, then you'll start getting things repoed. And it's not a pretty sight to get repossessions. Or if you've ever seen a repossession, it is not fun. They have dramatic shows like Dog the Bounty Hunter or whatever. They have repossession sometimes on there, and it makes it look fun, but I've seen it firsthand, and it's not that fun. So next lesson, we're going to be talking about how to manage debt, how to avoid scary things like foreclosures, bankruptcies, and repossessions. So stay tuned for our next lesson. See you then.